Some of the richest Americans pay little to no money in taxes. We've all heard of Donald Trump paying $0 in taxes, even though he's one of the richest persons in the world. Warren Buffett, who's one of the most successful investors of all time, talks about how he pays a lower tax rate than his own secretary. Even if we move beyond the famous people, what you'll see is that rich people in general pay a lower tax rate than regular people. And the craziest part is, this is 100% legal. How do I know? Well, for one, if it was not legal, all of these people would be in jail. And the second way I know is because I have spent time studying the federal income tax code. What I can tell you is that while the federal income tax code is over 2,000 pages long in super small font, it really only tells you three things. Number one, it tells you how to categorize your gross income. Second, it tells you what deductions you can take from your gross income, which brings you to your taxable income. And then it tells you what the tax rate is based on your taxable income. That's all you get from these 2,000 pages. And then once you understand that, you are either going to have a big tax bill or a small tax bill. But rich people are always trying to figure out how to have little to no taxable income. And if they do have any taxable income, how can they have the lowest tax rate possible? There are four main ways that rich people do this, and these are things that you can start doing right now too. But I do have to advise you that before you make any changes to your financial situation or your taxes, make sure you talk to a professional, an attorney, an accountant, somebody that can make sure that you're doing it right. Because you don't want to run into issues or red flags with the IRS, because that could end you up in a lot of trouble. The first thing that rich people do is change the category of income that they get, because not all income is taxed the same. The money you make from your job, the money you make from what you do, comes with the highest tax rates and the lowest tax deductions. The money you make from what you own comes with lower tax rates and higher tax deductions. So the first thing that every wealthy person tries to do, which is something that anyone can do, is they work to recategorize their income. They don't just work for ordinary income. They invest their money into assets so they can eventually earn passive income. This is just the beginning of the ways that the wealthy legally avoid paying taxes. And if you want to learn more, make sure to watch until the end. One of the biggest ways that the wealthy legally avoid taxes is through tax havens and offshore accounts. These are countries or territories that have a low tax rate or no tax at all, and wealthy individuals and companies can move their money to these places to avoid paying taxes in their home country. This is not illegal, but it is frowned upon by many governments and organizations as it can lead to a loss of revenue for the country. One big example of this is the case of Amazon, which was found that it had been using a web of subsidiaries in Luxembourg to avoid paying taxes in other European countries. The European Commission ordered Amazon to pay around 250 million euros in back taxes to Luxembourg, stating that the company had received illegal tax benefits from the European Union member state. This is just one example of how tax havens and offshore accounts are used by the wealthy to legally avoid taxes. But the problem is not limited to these countries or companies. It is a widespread issue that has led to a significant loss of revenue for governments and has led to calls for stricter regulations and greater transparency in the financial system. One of the ways that governments have tried to combat this issue is by implementing stricter regulations and greater transparency for offshore accounts. For example, many countries have adopted the Common Reporting Standard, which requires financial institutions to report information about their foreign account holders to their home country's tax authorities. This makes it more difficult for individuals and companies to hide money and assets in offshore accounts. Additionally, Many countries have also signed agreements to share information and cooperate with each other to combat tax evasion and avoidance. Another way that governments have tried to address this issue is by introducing a concept of economic substance to tax havens. This means that companies must prove they have sufficient economic activity in the tax haven to justify the tax benefits they receive. This is meant to prevent companies from using tax havens only for tax avoidance purposes. Despite these efforts, the use of tax havens and offshore accounts remains a significant problem. It is estimated that trillions of dollars are held in offshore accounts, and the true extent of the problem may be even greater as many individuals and companies are able to evade detection. With this, there is a need for continued efforts to combat this issue and to ensure that everyone is paying their fair share of taxes. One example of ensuring that everyone pays their fair share is through increased enforcement of tax laws and regulations. This can be done through increasing audits of high net worth individuals and businesses, implementing stricter reporting requirements, and increasing penalties for tax evasion. Governments can also work to close loopholes in the tax code that allow the wealthy to avoid paying taxes. This includes limiting deductions and credits for the wealthy while implementing a progressive taxation system where those with higher incomes pay a higher percentage of their income in taxes. This would be a tax on the net worth of individuals or companies above a certain threshold. This approach is designed to ensure that the wealthiest individuals and companies are contributing their fair share to the government's revenue. For example, if a country has a wealth tax threshold of $1 million, individuals or companies with a net worth above $1 million would be subject to a certain percentage of tax on the amount above that threshold. This tax is typically levied on assets such as real estate, stocks, bonds, and other investments. Some countries, such as France, have implemented a wealth tax, but it is a controversial topic. It faced criticism for being complex and difficult to administer, and it was ultimately abolished in 2017. Despite its flaws, the wealth tax in France served as an example of one way in which a government can attempt to ensure that everyone is paying their fair share of taxes. Implementing a wealth tax requires proper administration and enforcement to prevent tax evasion and avoidance. Another way to legally avoid taxes is through deductions and tax credits. These are legal ways to lower your tax bill by reducing your taxable income. For example, if you own a business, you can deduct business expenses from your income, which will lower your taxable income. Charitable donations, mortgage interest, and other expenses can also be used as deductions. Additionally, some tax credits can be claimed which directly reduce the amount of taxes you owe. A great example of this would be a wealthy individual who owns several rental properties. They can deduct expenses such as property management fees, maintenance, and depreciation from their rental income. These deductions can significantly lower their taxable income, which in turn reduces their tax bill. It's also important to keep accurate records of all income and expenses in case of an IRS audit. Last but not least, another great way to avoid taxes is through planning and having a great management strategy to reduce your overall tax burden. This can include things like postponing income or accelerating deductions, using tax-favored investments, and taking advantage of tax-free retirement plans. These strategies are legal, but they require expert advice and planning to ensure they are done correctly and not in violation of any tax laws. Postponing income is spreading it out over several years to take advantage of lower tax rates in the future. You can also accelerate deductions by paying for business expenses in the current year instead of postponing them. You can also diversify your investment portfolio by including tax-favored investments like municipal bonds and real estate investment trusts, which offer tax-free returns. Also, maximize your contributions to tax-favored retirement strategies such as Index Universal Life Insurance, Annuity, Roth IRA, and 401k plans. By using these tax planning and management strategies, you are able to legally reduce your tax burden and keep more money in your pocket. It is important to note that these strategies require planning, and should be done in compliance with the tax laws. While these methods are legal, it is important to always consult with a professional, such as a tax attorney or accountant, to ensure that you are following all laws and regulations. It is important to consider the larger implications of tax avoidance and the impact it has on the overall economy and distribution of wealth. While it may be within an individual or company's legal rights to utilize tax havens or deductions to lower their tax, it contributes to income inequality and can have negative effects on the country's infrastructure and public services. We need to have a broader conversation about tax reform and the role of the wealthy in contributing to the greater good through paying their fair share of taxes. This can include implementing progressive tax systems, closing tax loopholes, and considering the implementation of a wealth tax. It is important to ensure that everyone is paying their fair share of taxes in order to create a more equitable and sustainable society. Thanks for watching. Like and subscribe for more. I will see you on the next one.